Hi, I'm Kenny Gott, Certified Financial Planner Consultant and President at Pycheck & Associates in Springfield, Missouri. Let's talk about efficient investing. See if spending less on your investments is better, or do you get what you pay for? We have a separate presentation on managing investments for tax efficiency, so be sure to check that out too. Efficient investing is a big part of my book, Bottom Line Financial Planning, Manage Risk and Fund the Good Life Your Whole Life. We'll give you a free copy when you meet with us, and if you like, we'll analyze your investment expenses to see whether you're investing efficiently, see if we can help you do better. Okay, a mutual fund or an exchange-traded fund or ETF is a basket of hundreds or even thousands of stocks and bonds. Many of you have these in your investment accounts, and we use them for our clients as well. And there are two flavors. Traditional active funds have a manager who buys and sells stocks and bonds, trying to match or beat the stock market. This trading activity is called turnover. Passive or index funds take the manager out of the picture. The fund simply holds a large number of stocks or bonds to mirror the markets with very little trading. An S&P 500 index fund, for example, simply holds whatever stocks are in the S&P 500 more or less. It's almost on autopilot. Now maybe you're thinking, don't you have to have an active manager buying and selling in order to get some growth? Well, this shows the U.S. stock market from 1926 through 2019. The blue boxes are years the markets were up. The brown boxes are years the markets were down. You can see there's a lot more blue than brown. In fact, the stock market grew 73% of those years. That's a good bet. Whether or not you have a manager fiddling with it, your money will grow long term. So the question is, does an active manager buying and selling do better than the stock market alone? If so, then they're worth their cost. Well, twice a year, the SPIVA study looks at all available active mutual funds. So let's look at 15 years of active mutual fund performance compared to relevant benchmarks. A benchmark is a yardstick like the S&P 500, for example, that measures whether a manager is any good. Here's how active fund managers for U.S. stocks performed. The blue area shows 87.2% of them failed to hit their benchmark. Only 12.8% of them, the little orange area, matched or beat the overall U.S. stock market. Not great. Here's international stock funds. About 15% hit their benchmark. The other 85% failed. Here's U.S. corporate bond funds. These managers did a little better, only failed 68% of the time, did okay about a third of the time. And finally, intermediate U.S. government bond funds, 88.5% failure, 11.5% success. So maybe 15 to 20% of fund managers beat the market any given year. About 15 to 20% lag the market badly. And on average, over the long run, they all lag the market by about the amount of their expenses. And this is across good bull markets, bad bear markets, it doesn't matter. So why not just find those 15 to 20% who do beat the market and just use them? Well, the problem is it's a different bunch of managers each year that beat the market. Sometimes one will win for 2 or 3 years or even 5 years, but eventually they all return to the average. A huge study called the Percentile Trap looked at the top 25% of managers, the top quartile in other words, and they tracked that 25% over a bunch of staggered 5-year periods. On average, after just 2 years, less than half of them are still in the top 25% on their performance. After 5 years, only about 1 out of 20 were still in the top 25%. So you can't just go with the manager who was a winner last year. That's called chasing returns, and it doesn't work. Look, it's not that some fund managers aren't more talented than others. This study did find that some managers are more skilled. The problem is they charge more for their funds. So they get rewarded for their skill, but it's clients who pay for it with higher fund fees. So the client would do just as well with an average fund manager who charges less. Another big study looked at 1,750 mutual funds, almost the entire universe of mutual funds at the time. They analyzed the costs of the buying and selling all those so-called expert managers do to try to match or beat the stock market. And they found that mutual funds with less turnover, in other words, less trading activity, perform 1.92% better. The manager's only job is to match or beat the market. And the more they try, the worse they do. Why? Well, it's because the stock market itself is efficient. Companies in the stock market are legally required to keep any information secret that would give some investors an advantage over others. So all investors have access to exactly the same company reports and the same news media reports about those companies at exactly the same time. So any new information is immediately priced in by thousands of traders acting on all of that information all the time. So to beat the markets, a manager would have to be smarter than all the other thousands of investors put together. And as we've seen, it's hard to pull that off consistently. So a lot of those active trades are a waste of money. You gain nothing. But the cost of those trades is a drag on your performance. So what is that cost and that drag? Well, first, the average expense ratio of a mutual fund, just to own the fund, is 1.31% per year. The trading activity in there costs an average of 1.44% per year, according to this enormous study. This is not in your prospectus. It's hidden. This study had to analyze thousands of trades to estimate the cost. So the estimated total is 2.75% per year. That's like a boat anchor. You have to make that up before you get any real growth at all. Now, most clients have more U.S. funds than the more expensive international funds, and there are less turnover expenses in larger size funds. So to be fair, we think the average expense for a lot of investors is closer to around 2% or so. But remember this tidbit, mutual funds with less turnover perform 1.92% better. So if we're estimating around 2% expenses for a lot of investors, then this just makes mathematical sense. Get rid of those expenses and you would do about that much better. So not only do active managers not add any value, they hurt your performance by about the amount of their expenses. Every nickel spent within an investment is a lost nickel, no longer growing for you. So here is a rare case where you don't get what you pay for, you keep what you don't pay for. This is what we mean by efficient investing. Keep your expenses low. It's just better. We can build a whole portfolio using index funds, so you get the overall performance of the stock market, again, minus expenses. So here's a cost comparison. Again, active funds average 1.31% per year just to own one. The average index fund, 0.13%. Active fund turnover costs about 1.44% per year. For index funds, we estimate 0.24 based on our own analysis of the index funds we actually use. So the average expense to own an active fund is 2.75%. For the index fund, it's a mere 0.37 of 1%. The passive index fund costs an average of 2.38% less. So just logically, it's going to do about that much better each year. So again, based on real-life client portfolios, we try to be conservative and say you'll save maybe 1.5 to 2% per year. So on average, you'll do about that much better with index funds. Now, we sometimes do a retirement analysis where 1 or 2% more growth will make the difference between making it through retirement or not. Or to flip that over, you could be a little more conservative with your investment mix and not give up any growth. And by the way, since there's a lot less trading inside index funds, they're more tax efficient, and there are other advantages we can talk about when we get together. Now, either way you go, on top of those expenses, you're going to have an advisor fee. Now, we're financial planners, not just investment consultants, so that advisor fee gets you a lot more services with us. Retirement income planning, risk management, and estate planning concepts, all kinds of valuable help, in addition to building a cost-efficient portfolio for you, vetting those index funds, rebalancing, distributing income, all the services we provide. But if you're paying for a financial advisor anyway, which type of funds do you want them to use? The lower cost funds, right? If your advisor isn't already investing efficiently for you, you can either direct them to this video or let us take over. Now, here's our number. Call for your complimentary consultation and we'll see how cost efficient your investments are, see if maybe we can help you do better, and maybe you need a retirement analysis to see how much growth you need to enjoy a long retirement, what kind of investment mix will get you there, and we can use our recession reserve approach to help you worry less about the stock market or not at all. so you can focus on living the good life. Remember, it's your future, you earned it. Thanks for watching.